The next statement we'll look at is the balance sheet. And the balance sheet reflects the accounting equation, which is assets equals liabilities and equity. And as you may recall from an earlier presentation, we have assets in the company. So Intel has assets. Well, it didn't come from thin air either. They had to finance how to get the money to buy those assets. And those could be either from borrowing money, we call that liabilities, or from getting money from shareholders and letting their profits stay in the business. That's called equity, right? A company has assets. Those assets are financed from either liabilities or equity. And that is the reflection of the accounting equation and what we see on the balance sheet as of a date. As you recall, balance sheets are as of a date, a snapshot. All right, so this is a fairly complicated balance sheet for a company. Intel's pretty big, so you would imagine that'd be true. So let's just take a first extraction of what we see. We see they have certain liabilities, equity, and assets, and that is, again, the accounting equation. One, a ratio, again, to show relationships, is what is the liabilities to total asset ratio, which means out of every dollar of assets Intel has, how much of that was financed from borrowing money? In Intel's case, it's 41.7%. So in a sentence, for every dollar of assets that Intel owns, 41% was financed from borrowing money, from bankers or from other parties. That's how the ratio works. Now we compare 1 year to the other, we get a bit of a trend. It's a 2-year trend, so don't get too excited, but it is nonetheless a trend. They went from 44% to 41%. So you think about, their debt went down as a percent of assets. Oh, therefore, they were financing more of their business in 2018 from equity than they did the prior year. And normally, when we see that number drop, it conveys that there's lower risk of the company not being able to pay their bills, right? Makes sense? The more money you borrow, the higher the risk you have of not paying them back. The lower the amount of money you borrow, the lower the chance that you won't have money to pay them back, and therefore you're a safer business, or sometimes called a healthier business. So let's do a deeper dive into balance sheet. Just from glancing at this, shows you this is much more complicated than the income statement. The first section comprises assets. Within the assets section, there's a hierarchy of what's presented. The first break is current versus non-current. Current assets are those assets that are already cash or that will become cash within 1 year. Non-current, by contrast, are assets that stick around. They're sticking around for more than a year. When we now look at the line items inside current assets, we see things like cash, that you can't get more current than cash because you have it in your bank or checking account right now. Then you have marketable securities. This is stock that or bonds you may own. They're not cash because they're securities, but you could sell them today and get the cash within a matter of days when the market clears your transaction. So it's pretty close to cash. Next, we have accounts receivable. Accounts receivable are amounts that are owed to the company from its customers. When Intel sells chips to, say, Dell Computer, Dell will have a certain amount of time, usually a month or two, to pay back for those chips that they purchase. So during the period in which Intel is owed money from Dell, those are called receivables. So an accounts receivable is an amount owed from a customer to the company. Next, we see inventories. I think you know what inventory is. In the case of Intel, they're chips. So inventory is comprised of goods that are for sale, and they may be completed products like chips, or they might be chips that are yet to be produced. Maybe they're in the factory being made, or maybe they're still in raw material form. So the sum of all the things they have that will eventually become products to be sold are in inventories. Then we have other current assets. It's beyond our scope to go into every detail, but there are other assets that could become liquid in 1 year. And we get total current assets. So that's our subtotal. Again, we look a lot at the structure of statements and we see the value of subtotals. So we have current assets. The next are non-current. And non-current, the main asset for Intel in this area are their manufacturing plants. So they have distribution centers, they have office buildings, and they have very expensive manufacturing plants. Those are in what we call PP&E, property, plant, and equipment. In addition, they buy a lot of companies. And when they buy a company, the excess of what they paid for a company versus the tangible value of the company when acquired is goodwill. Don't think of it as you overpaid for something. Just think of it as the company you acquired has a lot more going on than things you could put your hands on. They're harder to estimate, but they're nonetheless valuable to a company. When a company like Google bought a company called YouTube, they paid a lot of money for a bunch of desks and computer equipment. So was that meaning that YouTube wasn't worth the money? No, it was worth a lot of money. So that excess over the tangible value of the assets and what Google paid for YouTube is called Goodwill. Well, Intel does that too, perhaps less visible out of your normal day-to-day conversation when Intel buys other semiconductor companies or other related businesses. But it's the same idea. Intel, as the big acquirer, spends a lot of money to buy another company. When they get the company in, the tangible assets are pretty small, and the extra value, which is really what comprises a lot of the acquisition, ends up in Goodwill. I say that because look at the number. It's $24 billion. So Intel has a large amount of money where they've spent to acquire companies. Let's say there's another company that has some very good technology that Intel would like to use. Well, they could buy the company, but a lot of times that's not available, and they may be very large companies on their own right. Or they may even be a competitor. In those cases, Intel will buy the right to use the technology from the patent, and for that right, they will then pay a certain amount of money. So those are called patent rights or intellectual property, but they're intangible assets, which means you can't put your fingers on them, right? When you buy a company, at least you know there's an entity you bought with factories, equipment, etc. But in case of an intangible, you can't quite touch it. And it's usually something to do with patent. And when we end up with the total of non-current, that's our next subtotal. So now we had current and non-current. When we add those together, we have total assets. So the sum of current and non-current assets equals total assets. That should make sense, right? Then we go to the other side of the equation, like how did we pay for this? There we look at first the liabilities, and we have short-term debt. This could be from banks or monies owed within the next year to another entity. And we have accounts payable, which are bills that we have to pay to people that do business with us. People that sell the raw materials to Intel would be included in accounts payable. Accrued compensation and benefit. These are monies you owe for compensation and benefits. In other words, Intel owes money to its own employees for bonuses, insurance, etc. And those are called here. These are the amounts owed for that. Then we have other items, again, a little bit beyond the scope of our work right now, is other monies that are owed to others and will become due in 1 year. And that gives us a subtotal of current liabilities. And if you see the pattern, we're going to do current and non-current, right? Correct. So next are non-current liabilities. And this could be debt. And debt could be comprised of loans to banks or on bonds that are more than 1 year from now. So if money is owed within the next year, it's current, but anything beyond a year is called non-current, and here's debt. So we get to this total non-current liabilities, right? So at that point, you could sum the current and non-current and get total liabilities. Then we have this thing that sounds a little unusual. It's called a non-controlling interest. What this means is, say Intel bought another company, but they didn't buy 100% of the stock in that company. They say own 90%. And the other 10% is owned from the original shareholders or founders of that company. So therefore, Intel will count all the money from that new subsidiary they just purchased, but they don't own it all. They own 90%. So they have to subtract a little amount that comprised that 10% of that small company owned by somebody else. And that's called a non-controlling interest. In the past, they may have been called minority interests. So you see both terms, but the proper term these days is non-controlling interest. And that's what this row represents, right? Now we get to equity. Equity are monies put in by shareholders. And notice I said shareholders and not common shareholders, preferred shareholders, or other flavors of shareholders. So equity are all flavors of shareholders. In the case of Intel, they had a class called prefer, but there's no stock outstanding. So they have it. It may still be possible to issue it, but there's none outstanding. That's why it's zero in balance. Common stock is the form of stock every company must have at least one class of common stock. And these are the general owners, if you will, of the stock in the company of Intel. Next, we have accumulated other comprehensive income, which is an accounting way to treat certain classes of transactions. We won't, again, beyond the scope of our studies here. Retained earnings is something that is quite important. This is the net income earned by the business minus the dividends the business paid to its shareholders. So let's say we made $10,000 and we say, okay, great, let's give $2,000 of that back to our shareholders so that they could have some benefit from us having a good year. So those are called dividends. So net income minus dividends is the amount that is kept in the company to grow the company. What do we call that? Retained earnings. Notice the words tell you what it is. It's earnings that have been retained as opposed to paid out by way of dividend. All right, when we sum those, we get shareholders' equity. And if we add the current liabilities plus the non-current liabilities plus the non-controlling interest plus the equity, we will end up with the total that, we'll just shade that here, which is total liabilities, equity, and stockholders' equity. And that number must total the same as this one. Let's see if it does. 127,963. 127,963. All right, so we're in balance. And that's what a balance sheet means. It's the accounting equation, right? So that's the balance sheet. A little more complicated, but Intel has a lot of things going on. So let's go back to the third statement.